From the 16th largest bank in the United States, gone in a week, I'm going to explain the Silicon Valley Bank and why you're probably hearing about it all over the news. And then I'm going to tie it into how this affects real estate with you and me. So if you don't know who I am, my name is Christian Stubbs. I'm a co-founder and team leader here at the SB Luxury Group. And I'm really just going to explain this in simple English. So I've got three major points that I'm going to hit. Let's talk about what is Silicon Valley Bank. Well, just like any other bank, it's a bank. And they have a specialty, and as I'm sure you can imagine, being in Silicon Valley and being that big, they specialize in funding technology companies. Most of these companies are venture capitalist backed, and the money comes from Silicon Valley Bank. So a lot of their major customers are giant tech companies that are in the early stages of their startup, maybe a little bit more mature, but they're startup companies. Here's a few of their major clients that you probably heard of, and this is specific to the real estate space, is they are Open Door, they are Airbnb, and Ojo if you've ever looked on Movado.com. Now really, it's just like any other bank, but they do specialize in technology companies. So now that moves us to our next point, is why does it fail and why are we even talking about it here? Why did it fail is really two major different things, and it's still early. There will be a lot more information that comes out on this story. Number one is they were very deep on technology. They had a lot of customers that were all in one sector of the economy, technology obviously being a huge one. And if you've looked or followed stocks at all in the market the last couple of years, technology's taken a huge hit. Facebook stock, Amazon, I mean, everybody took a hit in the technology sector. So of course it makes sense that the bank for these companies is also taking a hit. Now that's number one. Now banks also, what they do is they take money from their customers and they put it in their bank. Now they don't just have it sitting in the vault, they go reinvest this money. Now what's happening is a lot of the banks are going to be investing in bonds. Now bonds follow the interest rates, and when interest rates go up, the bonds that they bought 6 months or a year ago become worth a lot less money. And that's a big problem when all of a sudden there's a few banks or there's a few customers that start pulling out a whole bunch of money and it starts scaring everybody. They now have to go sell those bonds in order to fund people pulling money out of the bank. Interest rates are higher than they were when they bought these bonds, the value goes way less. So let's just say, for example, if they had $100 million in bonds and they sold them after interest rates went up, they were really only worth about $800 million. So they lost a ton of money on what they were selling in order to fund people that were taking money out of the bank from fear. Now, next what happened is there was some really big companies that pulled all their money out of the bank, and that the dominoes just started falling. At the end of the day, it's really pretty simple, but when you have a bank that's so specialized in one single sector, and on top of that, interest rates that have gone up, it really affects that bank's ability to service all these deposits. That's really why it fell. It's pretty straightforward. They were really deep in one niche, and interest rates increasing didn't exactly help them when people went to pull out money. So how does this tie into real estate? Well, let me give you, this was kind of the teaser I talked about at the beginning, is when you see a ton of layoffs, or if this bank collapses, or it has, this bank has collapsed, and not just in property technology, the companies that I mentioned, but all their other companies, if a lot of these big companies cannot service their payroll, you're going to see a lot of layoffs. And if you see a lot of layoffs, what typically happens is that hurts the overall economy. When you see the economy hurting and when you see layoffs happening, that's a recession, right? That's when we're seeing that we're in a recession, and a recession leads to lowered interest rates. And this is what nobody's talking about in the marketplace. Lower interest rates is only going to come once there's enough pain in the economy. And if we see all of these waves of layoffs, this may be being a spark, and there might be other things in the future. A recession leads to lowered interest rates, and that is what is going to bring the housing market back. So that's my 2 cents. I think this could be a good indicator for rates coming down sooner than a lot of people are thinking, but there's probably going to be a little bit of pain. It's going to be interesting to see this thing unfold. If you are not already subscribed, not only just to the YouTube channel, but our newsletter where we send videos like this out and information on this every single Friday. Go over to ocmarketupdates.com and register for that newsletter. And again, if you haven't subscribed for the YouTube channel, you might want to do that as well too. So again, I appreciate you watching the video. I would love to hear your comments of what you think is going to go on. Drop those down below or reply to the newsletter, and I will talk to you soon.